Right. Hi everybody. Welcome back. Today we're going to have the second class on insurance. So yesterday we talked about the motivation for insurance and why insurance may be a good idea. We discussed some theory about the potential effects on consumption and investment choices. And then we talk about some empirical evidence from agricultural insurance and health insurance. Today, we're going to talk about demand for these insurance products. Okay, and we'll start with a potential puzzle. Basically, the fact that even if insurance seems to benefit those who subscribe, at least in the realm of production insurance, of crop insurance, demand remains low. Okay, and we will, present these and discuss a few pieces of research that have tried to provide explanations for this puzzle. We will then dig into one potential reason for the limited insurance demand, which is the way that products are designed, and in particular the fact that many insurance products require upfront payment of the premium and only provide benefits at a later stage. So a temporal mismatch between the timing of premium payments and the timing of the payouts. And then in the final part of the class, we will talk about a related but distinct problem, which is the problem of insurance renewal. Okay, so the first 2 points of the class are about getting people to subscribe for the first time, and the last part is about the issue of renewal subscription, okay, which presents a different set of challenges and of potential rooms for intervention. Now, similar to yesterday, we will take a brief break in the middle, a couple of minutes. Also, similar to yesterday, I'm borrowing some of the materials here from slides by Jing Kai, Ariane Ornaghi, and Jack Willis that I thank again. Okay. So low demand, why is this a puzzle? Well, we've seen from some example yesterday, but also from many other papers, that insurance, and I'm primarily referring here to crop insurance, which is the one that has been the most studied in developing settings. Insurance seems to benefit farmers in terms of investment, increasing outputs, and other indicators. Okay, so we saw these in the Carlan and co-authors study yesterday, right? Where we saw indeed that among farmers in Ghana, receiving insurance led to an increase in investment and output, and this increase was substantially larger than the one induced by a capital grant. So it seemed to be the case that the risk was the binding constraint. Okay, and again, similar results are found in many other studies, though not in each of the studies that has looked at insurance. Okay, now you will think, okay, if there is such a clear benefit, there should be demand for this product, and this is not the case. Okay, in spite of these positive effects, demand for crop insurance is low when farmers must pay for it. So in this study, in the Carlan et al. Study, I think insurance was given for free initially, and then was heavily subsidized. So in some of the later years, they varied prices to estimate demand. And you notice two things. So the prices in these red ovals are the ones that will make the insurance roughly actuarially fair. Okay, meaning that the value of payouts will be in expectation similar to the value of the premium. Okay. And you see that at these actuarially fair prices, about 40% of people demand any insurance. This is low, and then not only few people demand it, but those who demand insurance, those who want insurance, buy it for a small share of their total acreage. Okay, you see that at these prices, for those who buy insurance, this is about 20% covered. Okay. Now, demand, both on the extensive and on the intensive margin, is even lower when we consider higher prices. And why we care about higher prices? Because in practice, in the commercial realm, insurance companies not only care about making prices premia actually fair, but they also must cover distribution costs, transaction costs, etc. Okay, so accounting for these costs increases the value of the premium, and at these higher premiums, the demand, is even lower. Okay, and so again, this type of low demand, this finding of low demand is found in many settings, not just in this example. Okay, and so a large literature has tried to explain this puzzle. Okay, again, why a puzzle? Because there are benefits that seem to be quite common across studies, but there is this low demand. So we will review some of these explanations, and then we'll dig into one of these. Okay, so let's start with going back to the concept of index insurance, right? Yesterday, when I was talking about this microinsurance revolution or microinsurance movement, I highlighted the fact that a lot of these developments were based on the concept of an index, on the fact that payouts will not depend on the losses of, let's say, each individual farmer, and therefore payouts will not require verification of each individual farmer's losses. Rather, they will depend on an index like rainfall in the nearby rainfall station or variations of this. Now, this has, the main advantage is that this reduces the costs, verification costs, and potentially addresses some of the asymmetric information problems in these markets. Okay. However, the other side of the coin is that there is now a mismatch between the index that determines the payout and the loss that the farmer experiences. There will be some states of the world in which the farmer experiences a loss, but that loss is not captured by the index used by the insurance. Okay, so let's say a farmer experiences a loss because there are pests, but the insurance only covers adverse rainfall events. And so this mismatch between the index and the actual loss is called basis risk. Okay, this is a concept, important concept in insurance design. Now, a very simple explanation for low demand for insurance is that basis risk worsens the worst case outcome. Okay, so let's look at this table. So the first column is basically the state of the world in which the farmer experiences a loss, okay, but the index is not triggered. Okay, again, the farmer has pests, but the insurance only covers bad rain. Okay, or the farmer has in the area where her plot is located has a poor rain, but maybe the rainfall station is 20 kilometers away, and around there the rain is good. Okay. So in this state of the world, what happens? It happens that the farmer pays the premium, and in addition gets the loss. Okay. So his income here is really the wealth minus the premium minus the loss. Okay. And buying insurance in the state of the world makes things worse relative to a case in which the farmer does not buy insurance and so doesn't have to pay the premium. Okay. Now, given that basis risk worsens the worst case outcome, okay, in a simple model, an extremely risk-averse person may not want to buy insurance. Okay, like an extreme risk-averse person is one that primarily cares about the very worst state of the world. Okay, and more generally, the relationship between risk aversion and demand for insurance will be complicated, will be non-monotonic and not necessarily super well-behaved. Okay, so there's a very nice applied theory paper by Clark published a few years ago on this. And there's also some experimental evidence that shows that when you make the basis risk more pronounced, for instance, when you tie insurance payouts to a farther away rainfall station, demand is lower. Okay? So there is some empirical support for the idea that farmers understand this concept of basis risk and respond to it when it comes to demand for insurance. Okay, so another explanation, like for many other technology adoption problems, has to do with prices and liquidity. Sean Cole and co-authors in one of the first papers looking at evaluations of insurance in developing countries. In this paper published in 2013, a number of experiments in India. So what they did was varying price discounts, okay? And they show that demand is very low and very responsive to prices, very, very elastic, okay? And so in the case of that experiment, the payout premium ratio was low at commercial prices, but they show that even if the payout premium ratio were more favorable, for instance, comparable to the one observed in the US products, nevertheless, demand will be very low. Okay? And again, it is the case that farmers, when they buy insurance for a small portion of their land. Okay? So prices matter, liquidity also matter, right? Farmers may be liquidity constrained. This is one thing we discussed yesterday. And so in this experiment, or in this paper, and in another treatment, the authors provide a cash grant that is large enough to cover the premium. Okay? And this treatment raises take-up substantially, suggesting again the liquidity constraints may matter. Okay? Of course, when you do this type of treatment, it's a bit complicated because the very fact that people receive cash around the time that they have to buy insurance may lead to some type of pressure, social pressure. So it's a bit hard to distinguish the liquidity story from this other type of social pressure issues. But this study and others later do suggest that liquidity constraints may be a reason for low demand. There is some other recent work that I wanted to highlight that also looks at prices and subsidies in a different context. So this is a context of health insurance. Okay? In a recently published paper from last year, Banerjee and co-authors study how to increase enrollment in government health insurance in Indonesia. And this insurance has an individual mandate that is, however, weakly enforced. Okay. And so in one of this is a large-scale randomized control trial, and then one of the treatments, they offer subsidies. However, these subsidies are time limited, meaning that households receive an offer to get this insurance at a lower price, and this offer is only valid for 2 weeks. Okay. And again, consistent with this elasticity story, this relatively high elasticity, subsidies do seem to increase enrollment substantially in the treatment group. However, in the context of health insurance, subsidy not only seem to be increasing demand, in the whole population, but they also seem to allow enrollment or to foster enrollment of healthier people. Okay. In other words, they seem to foster enrollment of people that are in better health conditions, or they are less likely to file a claim during the insurance coverage. This is an important point because this type of large-scale government insurances, of course, suffer from concerns about adverse selection. Okay, the fact that only sick people will buy these, and in settings where these individual mandates cannot be easily enforced, these concerns about adverse selection are particularly relevant. Indeed, in the control group, the authors find that people are strategic when it comes to enrollment. They basically wait to be sick, and when it's sick, they are more likely. When they are sick, they are more likely to enroll in the insurance. Once a subset of individuals, of households, sorry, receives the subsidy, and remember, this subsidy are only for a limited time, then this helps address this concern about strategic enrollment. And so, for instance, if you look at this table in column 1, this is a self-reported health index. You see that those that are enrolled in the full subsidy group have better health than those that have no subsidy, and also that they are less likely to file a claim, right? And a full subsidy, the likelihood of filing any claim during insurance is substantially lower than the likelihood in the group that enrolls in insurance without subsidies. Okay? In other words, these limited subsidies change the selection into who enters in the insurance pool. Okay, so another reason is trust. When going back to the crop insurance, it is the case that in many of these settings where these efforts have been conducted, few farmers had exposure to any insurance product before the one that was tested. For instance, they may not be familiar with the insurer, they may not trust it, they may fear that the insurer will run away with the money of the premiums and default. Okay? And notice that when farmers have to pay premia, let's say at the beginning of the insurance coverage, all the moral hazard, all the default, the strategic default temptation is on the insurer. I will come back to this point later. Okay? And there is some evidence for the importance of trust as a determinant of insurance demand. For instance, in the India study that I was discussing earlier by Cole and co-authors, they also randomized whether insurance was endorsed by a local well-known NGO, and this endorsement increases take-up to some extent. So in the Indonesia health insurance study that I mentioned earlier, they not only offer these time-limited subsidies, but they also randomize assistance for the online registration. Okay, and just providing this assistance leads to some increase in enrollment. Okay, however, inducing people, supporting people in the online registration also highlights another type of challenge that may reduce demand and use. So this basically, these assistants induce many people to try to register, but many of these people were only able to start the process, to attempt the registration, but did not conclude it successfully. Okay, there were technical and administrative challenges in the online enrollment system. For instance, one example is that once you get in the system, you basically have to register your family, and the civil registry that was used, to create the database for this insurance was inaccurate and obsolete to some extent. And so if people found that the information in the system was not correct, for instance, in terms of who was part of the family, then they will need to go and visit an office to rectify family composition. Okay, and this, of course, induces additional hassles, additional costs, and implied a big dropout. Many people started the process, but did not finish it. Okay, and of course, we hear a lot about state capacity as an important determinant and correlate of economic development. And this is one example in which limited state capacity matters in practice. It's a very maybe simple thing, a registry that is not updated, But in contexts where it's hard to update these registries, this seems to have big implication on an important outcome like insurance coverage. Okay. Another explanation that I want to highlight is one that relates to the topic of some of the previous classes. When Chris you taught, you discussed the scope and performance of risk-sharing arrangements, for instance, of insurance, informal insurance, across members of the same village or the same network. And so one could ask the question of whether the presence of these informal insurance networks limits the benefits of formal insurance. Okay, so first of all, if this were the case, it's a legitimate question. But first of all, if this were the case, then it would be hard to explain why providing formal insurance generates these large effects in terms of investment and output, for instance. In addition, you should have learned from the previous classes that these informal insurance arrangements, while subject to different type of limitations, they may work well in covering idiosyncratic risk, but not aggregate risk at the level of the community, right? Suppose we are in a risk-sharing arrangement within a village. If the entire village is hit by a drought, there's not much gains from pooling risk across members of the same village. Okay, and so this is to say that formal insurance and risk-sharing arrangements may complement each other by covering different types of risks. Okay, and also, for instance, by covering limitations of the other insurance. For instance, informal insurance may complement formal insurance that present basis risks. And so in another experiment in India, Mubarak and Rosenzweig show indeed that communities where risk-sharing arrangements protect well from local risks, okay, if anything, have higher demand for formal insurance. Okay, so this is just an overview that shows that academics have been trying to deal with a number of explanations. I don't have time to cover all of them. Other channels include social networks, financial literacy, for instance. We'll actually come back to some of these in the final part of the class. And this evidence shows that addressing the price barriers and non-price barriers increases take-up to some extent. However, even for instance, when we give subsidies or these liquidity transfers, or when we try to address trust issues, demand for insurance seems to be stubbornly low. Okay, and again, this is in many different settings. And so one conclusion here is that this may mean that the poor do not value risk management products. Okay, maybe for reasons that we don't fully understand, they seem to benefit from it, but they may not value it. And so in the second part of the class, I talk about some work that I did, co-authored with Jack Willis at Columbia University, where we highlight one important feature of insurance products, which is the mismatch between when you pay premiums and when you benefit from it. In other words, we highlight the intertemporal nature of insurance products. And so I'm going to go a bit in detail to some of the components of this paper, which is called Time versus State in Insurance. And it's an experiment in Kenya. And so as a starting point, it is useful to go back to the very same, to the very concept of insurance. Okay, think of a farmer that plants at time t in the planting season, and then harvests in the harvest season, period t+1. And at harvest, there are two states of the world. There is a good harvest state, and there is a low harvest state, high harvest and low harvest state. Okay, and what is insurance? In our textbook model, right? Insurance is a transfer of income across states of the world, right? We aim to transfer income from the good state of the world, so to periods in which the harvest is good, to periods where the harvest is bad. Okay? But standard insurance products also require a transfer of income across time, right? Because I pay the premium upfront, and then I benefit in a bad state of the world, but this state of the world is also a later state of the world. And so I pay the premium upfront for an uncertain payout that I only receive in the future. And so standard insurance products present an important deviation from the textbook characterization of insurance. They require a transfer across time and not only a transfer across states of the world. And so the question is, what are the implications of this time transfer, of this transfer across time for demand for insurance? So, of course, when you charge the premium upfront, companies can ensure that everybody who subscribes pays for it, because the premium payment is a necessary condition to get subscribed to insurance. But in doing so, they also activate intertemporal factors. So now the decision to take insurance will depend on time preferences, on liquidity constraints and other factors, not only on the risk preferences or on the demand for risk management. Okay? And so the question is, does this transfer across time affect insurance demand? Why is it the case? And for whom may this transfer be particularly relevant? And so again, this is a question that is important, given that boosting demand for insurance is an important policy goal. Okay? And in particular, boosting demand for insurance is relevant for farmers, right? A lot of the examples that we have described both yesterday and in the class today are concerning crop insurance, given that farmers face risky income. Okay? However, in these settings, it's not only the case that producers face risk, but they also face cyclical incomes, right? There are hunger periods during planting, for instance, and then periods in which they have much more cash, which is at harvest. And so the insurance here may help smoothing over states, but may hinder smoothing across time by requiring farmers to pay at planting, which is potentially when they don't have much money. Okay, so this is just some related literature. I'm going to skip these. And let me tell you a bit about the setting of the experiment. So we work with a large sugarcane company, in East Africa. It's a setting like many other settings in Sub-Saharan Africa, characterized by smallholder production, so very small plots, very little experience with insurance. Sugarcane is an important crop in this region, and it's a very long crop cycle. Between 1.5 years, a bit more sometimes, and so this is a setting in which this transfer across time may be particularly relevant. So how does it work? The farmers contract with the company, and they contract to sell to the company. And the company harvests the crop at harvest time, sends their workers, and pays the farmer by weight. Okay, so this is a contract farming setting. Some of you may be familiar with the concept of contract farming. But basically, one important feature of contract farming is that the credit is interlinked with the output contract. So the farmer commits to sell to the company, but the company commits to provide inputs to farmers on credit, like seeds or fertilizer, and then deducts this input cost plus interest from the harvest revenues when the farmer sells to the company. And so the idea is that to remove the intertemporal transfer that is implied by the upfront premium payment, we can basically use the same mechanism in which the insurance premium is deducted plus interest at harvest time, okay, from the crop revenues that the company pays to the farmers. Okay, and so we are interested in testing whether introducing this interlinked insurance product changes demand for insurance. And so what do we do? We do a randomized control trial with 600 farmers, okay? So about 1/3 of these farmers receives a standard actuarially fair index insurance. So let me not go in detail of how the index is computed in this setting, okay? And demand is very low, okay? Demand is 5%. This is low, but in line with previous work, especially because farmers could choose either to insure their whole plot or none of it. Okay, they could not choose to insure 20% of the plot. Okay, so this low demand is in line with previous studies. Now, in a second treatment, we randomize a large price discount. So this is a 30% price cut, but again, while retaining the upfront premium payment. So this is a standard product in which you have to pay the premium upfront, and demand maybe goes up by a bit, but overall, this 30% price reduction has very little effect on demand. Okay? And then in the second treatment, what we do is we offer this pay at harvest insurance, in which farmers have to subscribe for insurance to express their willingness to get insurance at the beginning of the season. But then if they sign up, they don't pay immediately. They get the insurance premium deducted from the harvest revenues. Okay? And so what you see here is that the demand for insurance increases substantially. Okay? Increases by 67 percentage points up to 72%. Okay? So this is evidence that eliminating this intertemporal transfer related to crop insurance substantially has a substantial effect on demand. And there are several potential explanations here of why providing pay at harvest insurance may lead to such a dramatic increase in take-up. Okay? One has to do with the fact that that requiring upfront payment, right, may trigger liquidity constraints, may imply that liquidity constraints bite on demand. The other is that given that costs are now in the standard upfront premium payment, given that costs are now, but that the benefits of insurance are only later, then this may imply that intertemporal preferences of the individuals may matter. Okay? For instance, if farmers are present biased, okay, they may not value a product that requires immediate payment now and only future benefits. Okay? So a third one is that shifting the premium payment from the planting time to the harvest time also shifts the potential for moral hazard, right? We said earlier that when you pay upfront, when let's say a farmer pays upfront at planting time, all the moral hazard temptation, all the default temptation is on the company that can run away with the money. Okay? Now, on the other hand, when you no longer require farmers to pay at the beginning, then the question is about enforcement, because could it be that the farmer finds a way to default on insurance? And so this is obviously an important element for designing these products. In our case, this is particularly relevant, given that there was a temporary closure of the factory about 1 year after the experiment began. And this has implications that, that imply that counterparty risk may also be one important source of, more important determinant of the change in demand when you give pay at harvest insurance. And there are other behavioral channels that I don't go in detail. Okay? So we are going to examine these 3 explanations, okay, in detail with additional experiments and additional analysis. And we'll try to understand whether they can contribute to this large increase in demand for insurance when you switch from upfront payment to pay at harvest. However, before I do that, let me pause a second and see if there is any question. I don't see any question in the Q&A, but let me pause a second in case anybody wants to write a question now.
I don't think we have any questions at this point, but it's a good moment to remind people, if you do want to ask something, just put it in the Q&A.
Great, thanks very much. Okay, and so in the second part of the paper, what we do, sorry, there is actually a question by Samira. So no, this is, so she asks, is the payment at harvest in full or partial? No, this is in full. So actually, let me clarify. So in this treatment group, right, in the third group, the entire premium is due at harvest plus an interest rate. So the idea is that we want to keep the NPV of the premium payment in the groups similar. And so for those that have to pay at harvest time, they have to pay the premium plus an interest. Okay. Good. Yeah. Okay. So in the second part of the paper, we conduct additional experiments and we conduct additional analysis to provide evidence on the role of these various channels. Okay. And we also develop a model that helps us understand the role of these channels. Yeah, of course, I mean, I don't have time to go through the math in detail, but let me give some insights about the model. So this is a model that builds on the seminal work, a seminal model of buffer stock savings by Deaton, with present biased, naive, time inconsistent farmers in this case, these beta delta preferences that you may be seeing in other courses. Okay? And we try to understand what is the impact of introducing marginal units of insurance in the pay upfront case and in the pay at harvest case. Okay. So what are some of the implications of the transfer across time? That now when you have to pay upfront, the liquidity constraints matter. And if there are liquidity constraints, then intertemporal preferences will matter too, because the interest rate will not be the relevant metric to exchange the relevant parameter governing the exchange of money between now and the future. And so there is now a tension between insurance and self-insurance, okay? Because by requiring you to pay upfront, this will decrease your ability, for instance, to save and to build buffer stock savings. Okay? And this tension between insurance and self-insurance may be particularly pronounced for the poor, for which liquidity constraints are likely to matter. And so given that there are borrowing constraints, there are precautionary savings, okay? And these borrowing constraints and the limited ability to to have self-insurance to cope with risk imply that the benefits of a risk management product, of a pure risk management product that only imply a transfer of income across states, are higher for the poor, right? The benefit of a textbook insurance model will be higher for the poor. However, an insurance that requires upfront payment also implies, also as a cost, also features an intertemporal transfer, and this cost is also higher for the poor. And so while the benefit of a pure insurance product may be higher for the poor, the cost of an upfront premium payment insurance are also higher for the poor. And so we would expect that shifting from an upfront to a pay-at-harvest insurance product will be particularly beneficial for the poor and the liquidity constraint. And so this is the first test that we examine. So what we can do is where we can conduct heterogeneity analysis. Okay, we can test whether the increase in demand for insurance when you go from pay upfront to pay at harvest should be larger for certain types of farmers. Okay, and so for instance, we find that those that have more land, so that are richer, are less affected by the change, have a smaller change in demand when they are offered the upfront, the pay at harvest insurance. Okay. Similarly, those that have cows or those that report having more savings, okay, have a lower impact, lower increase in demand for insurance when you go to pay at harvest. On the other hand, farmers for whom sugarcane, which is the crop targeted by the insurance, as a larger part of their total crop portfolio, experience a larger impact, a larger increase in demand when they are offered the pay at harvest treatment. Okay? And so, again, the effects of shifting from upfront to pay at harvest are larger for the poor and for the liquidity constraint, according to a number of proxies that capture these characteristics. Okay, so we do a couple of experiments, small-scale experiments, to identify channels. Okay, so the first one is indeed one that relates to liquidity. So we do a similar treatment to the one that the Cole and co-authors did in India. We give farmers enough cash, okay, an unconditional cash transfer. They can do what they do with that, what they want with that money. But this cash transfer is large enough to cover the premium. Okay? So this cash transfer may ease liquidity constraint. Of course, it may not remove all of the liquidity constraints. There are many other things that you may want to do with this money, and there may be trade-offs. Again, giving this cash transfer may also induce reciprocity, so it's a bit tricky to interpret. And what we see is that the cash drop does increase take up in the upfront premium payment. Okay, in this sample, it's a bit higher. It's like from 13 to 33%. Okay, but two things. One, this effect is substantially smaller than just offering the pay at harvest insurance. Okay, and the other point is that you know, the difference in difference, like this cash drop, also increases demand in when it's combined with pay at harvest. Okay, we suggest that at least a part of this increase from 13 to 33% does not come from liquidity, but for instance from this pressure or reciprocity. Okay, and so this suggests that shifting from upfront premium payment to a harvest premium payment may have substantially larger effect than easing the liquidity constraints of the farmers while retaining the upfront premium payment. Okay. So I think at this point is a good time to take a couple of minutes break. Maybe before doing that, let me answer. So, okay, so Samira asked a question which I've already answered, and then Sakina, let me have a look at your question. So I'm not 100% sure I understand your question. I think that you know, heterogeneities here are a simple way to show that the effects are significant across groups. We could also estimate, I think you're asking about some technical question about how we estimate heterogeneous effects. So an alternative would be, to split the sample and test whether the coefficients are similar in the two groups. We could also do that. This is, just alternative ways. I think the heterogeneity is a simple way to test whether the difference is significant in a parsimonious way. And then we could also pull together all the heterogeneities. It would be a bit harder to interpret. Let me know if I haven't. I think I've answered your question, but let me know if I haven't. Feel free to follow up in the Q&A. Thanks. If there isn't any other question, let's take a couple of minutes to break, and we'll stretch our legs and we will reconvene. All right, welcome back. So let's start with the second part of the class. So just to recap, we are finding in this paper that moving from upfront premium payment to payment at harvest has a very large impact on demand for insurance. And now we are trying to understand why this is the case. We're examining the role of liquidity constraints. Okay, we've shown that easing liquidity constraints on the margin does improve insurance demand, but not at the same level as shifting from upfront to pay at harvest. Now, the second experiment or mechanism experiment that we conduct tries to look at the role of time preferences. Okay, and so we're interested in understanding whether present bias, in particular, may explain why farmers may not value products that pay that require immediate cost, while giving only a benefit in the future in certain states of the world. Okay? So we try to isolate this mechanism. So what we do, with a different sample, we give farmers a choice. Farmers can choose between free insurance or the value of the premium in cash. And we randomize these farmers into groups. Okay? So both groups decide now whether they want the free insurance or the cash. And one receives the choice now in the first group, and the other group receives the choice in 1 month. And so delaying receipt by 1 month is similar to a 1 month delay in premium payment, but it is easily enforceable, right? Because now the farmer doesn't have to pay anything. It's just a choice on whether they want to get the cash or they want to get free insurance. So we are shutting down any potential mechanism that operates through counterparty risk or default. And then, if the farmer is liquidity constrained, right, this experiment will remove the present bias, okay? Because now the farmer will not have a choice between getting money now versus insurance now, but will make a choice that concerns receiving money in a month. This is in the second treatment. Okay. And so what we find that just a 1 month delay, okay, which is a much smaller, sorry, I should have clarified, it's a much smaller delay than the delay implied in our main experiment, which was like 1.5 years or something like that. So simply this 1 month delay leads to a substantial increase, 20 percentage points. Okay, we do the experiments in various times, different months, and we find very similar results. Of course, in this type of experiment, you never know if this is present biased, so if farmers are, beta delta, or if farmers are standard exponential discounters with very low delta. Okay? However, our sort of design suggests that what matters here is present bias. Why? Because if the farmers were exponential discounters, so every month they will discount by a very low delta, okay, as opposed to just discounting the first month, but then being quite patient in the future, which is the feature of present bias. So if farmers were exponential discounters with low delta, why would they care about buying insurance in 1 month? Because they would still not value a product that only benefits them at the end of the crop season in 15 months or so. Okay, so quantitatively here, the results are consistent with a model of present bias, not with high exponential discount. Okay, so the other channel is counterparty risk. Okay, so could it be the case that the option to default, for instance, on the contract, raises demand for insurance? Okay, so let's go back to the concept of interlinking that I was describing later. So in this contract, the company, has an agreement to buy from the farmer. And so if the farmer defaults on insurance, meaning that a farmer decides not to pay the premium at harvest time, this means that the farmer would also default on production. Okay? And so the benefit of the interlinking is that this substantially raises the cost of defaulting. Okay? Because again, if you decide not to pay the premium, you're also forgiving the benefits of selling to the company. Now, in our setting, there is one important aspect that complicates the analysis. So toward the end of the crop season, the company experienced serious financial difficulties, which led to a temporary shutdown of the factory. And remember, the company is in charge of harvesting the farmer's plots. And so they delayed this, and this led to uncertainty. And as a result, the company failed to buy from about half of the farmers. So in the contract farming literature, this is called side selling. Okay, so about half of the farmers didn't end up selling to the company. This is important, much more than what had been the case historically. Of course, this is an important issue to understand what was going on, why demand for insurance was high. And so our first question is whether insurance induced side selling. Is it possible that farmers were even more likely to sell to somebody else if they were offered this pay at harvest insurance. And we conduct analysis and we rule out this factor. Okay, we are able to see whether amount sold is affected by the type of insurance that you are offered. But there could be an even more subtle aspect, which is did the anticipation, if farmer anticipated a default, okay, we suggest this is not the case, but in principle, if farmers anticipated default, this will generate a gap between the demand for upfront insurance, for pay upfront insurance, and the demand for pay at harvest insurance. Okay, so we conduct several pieces of analysis that suggest that any role of anticipation of default was limited, did not drive the differential take-up. Okay, maybe I will not go through each of these, but first of all, let me highlight that in the previous experiment, the second channel experiment, we removed any enforcement concern. We were just allowing a choice between money now versus insurance now, or money in a month versus insurance in a month. And we show that in that example, there is also a big increase in demand when you delay sort of the opportunity cost of payment. And just a 1 month delay led to a 72% take-up rate. Okay, and then we do a bunch of other things that suggest that the role of anticipation was limited. The simplest one, we have heterogeneous treatment effects by, for instance, trust toward the company or relationship within the company. And we also have local variations in the amount of sex selling across different regions of the catchment area of the company. And we find that these proxies that we think are, variables that are proxies for ex-ante expectation of default do not correlate with the treatment effects, do not predict the treatment effect from upfront insurance. Okay. Overall, these and other arguments suggest that counterparty risk and anticipation of default played a limited role in driving the differential take-up. Okay, so to conclude on this paper, rather than recapping here everything, what I want to say is the following. From the previous studies, one could legitimately come and argue, look, these studies suggest that farmers do not value risk management products. Okay? And what our paper does, in this suggesting that no, farmers do value risk management products, pure risk management products, meaning products that only lead to a transfer of income across states, are highly valued by farmers. Okay? But standard insurance products also imply this transfer across time, and this transfer across time is costly, and is especially costly if you are poor. Okay? And indeed, removing this intertemporal transfer leads to a very large increase in demand for insurance. And both liquidity constraints and present bias play a role according to our mechanism experiments. Okay? So to some extent, our paper is a proof of concept that if one can work in a setting and design this pure risk management product, then demand will be high. Then a big question on which there is ongoing research is how can you design these products so that contracts are enforced, for instance. Okay? And I should mention that this very large impact of pay at harvest has been found also in other papers that have replicated this work. Okay, let me pause a second to see if there is any question about this discussion on the timing of premium payment.
Don't have any open questions at the moment. So yeah, if you do have any, just remember to put it in the Q&A box. Yeah, thanks very much. Then let me move to the third and last part of the lecture today, which is about insurance renewal. Okay, again, this is a different, related but different problem from inducing first-time adoption. This is the question of, okay, I bought insurance once, I've experienced it,
And then do I renew it for the second year, for the third year, and so on. Okay. And what are some of the factors that that may drive the choice to renew or not to renew? Okay. And multiple studies suggest that renewal rates are low. Okay. So not only it is hard to induce farmers to buy insurance in spite of these documented benefits, but also it's hard, if not harder, to induce renewal rates. Okay. And a number of studies in different settings, Ghana, India, China, among others, show that the renewal rates are low, especially when a household or a community do not receive insurance payouts in the first year. So I'm just taking one of these papers. This is again work by Sean Cole and co-authors, looking, follow-up analysis of the insurance product that was evaluated in the paper 2013 paper that I discussed earlier. Okay, so this is about the effects of receiving payouts in ERT on purchasing insurance in the subsequent year or in the subsequent season. I don't remember the details. Okay. So what they show is that receiving a payout, whether people in the village receive a payout, okay, in ERT, has a big impact on the likelihood that the individuals buy in the next period. Okay, this is true. Let me actually start from column 4. So you can divide the sample in two parts. So first, there are people who have not bought insurance in period T. So these people are much more likely to buy the insurance in the next year if the other villagers who have bought insurance experience a payout. And then in column 2, you see what? You see that again, the village payout in the previous season really matters. It actually, at least in this study, this is not always found, in other studies it's the opposite, but at least in this study, the village payout, so the share of people in the village who got insurance and got a payout, seem to matter more than the individual payout. So if I don't get a payout myself, but people around me get a payout for some reason, then this really matters. Okay. And then this is this result, the first coefficient here, is basically unchanged if we control for a measure of crop losses in the village. Okay, so why is this important? Because this result is saying that the impact of receiving a payout on subsequent adoption doesn't operate through the fact that basically receiving a payout means that the loss experience is more salient, is more recent. Okay, it's really the fact that I see that there are some payouts that maybe increases my trust for the insurance or makes me understand better how the insurance works. It's really this fact that matters in shaping adoption in the future, not just the fact that it's a bad year for everybody. And so maybe again, the experience of a natural disaster of an adverse event becomes more relevant, more salient, more recent. Okay, so yeah, so earlier in the lecture, we have examined papers that look at the impact of subsidies on first-time adoption. Now, there is another literature that was mostly outside of insurance that has examined how initial subsidies affect subsequent adoption on health technologies, agricultural products, etc. Okay, so let's discuss a bit this literature, and then we will relate it to the insurance adoption or adoption in the future. So giving higher subsidies in period 1 may have either positive or negative effects of adoption of the same product, of the same technology in period 2. Okay? So some positive effects, it may lead to habit formation. Okay? I get into the use of doing, into the habit of doing something that basically reduces the cost of doing the same thing in the future. Okay? Or it may increase my ability to learn about the product. Okay, so for instance, a very famous paper by Pascal and Dupin shows that giving larger subsidies for bed nets that protect from mosquitoes in period 1 increases adoption in future periods because expands the number of people who have this bed net in period 1, and they have opportunities to understand the benefits of it, to learn how to use it, etc. Okay, and more recently, Michael Carter and co-authors have a sort of related insights when thinking about agricultural inputs like seeds or fertilizer. Okay. But on the other hand, high initial subsidies may also lead to negative effects on future adoption. For instance, there is some hypothesis that when somebody gets a good for free, she does not use it well, or she does not fully value it. Okay, and so there may be lower learning, lower usage. This is sort of the sunk cost effect, and to be clear, there isn't much evidence for this, at least in the development space so far. And then another mechanism is price anchoring, right? It could be that okay, now you pay something with a high discount, and if the next period you have to buy the same good at a higher price, your reference point may be low, right? Maybe the price, the subsidized price for the previous year, and you may not be willing to buy it. And so ex ante, the implications of contemporary subsidies of future adoption are ambiguous. Now, in the case of insurance, the problem is even more complicated, okay? Because now the benefits of the insurance in the first year are stochastic, right? If it's a bad year, then if the first year is bad, then in that first year you really see the benefits. On the other hand, if the first year is good, the insurance does not pay out, and so the experience with insurance in the first year is negative. Okay? And so this further complicates the relationship between initial subsidies and future adoption in the insurance domain. Again, because the benefits here of insurance are stochastic. They are not the same every year. Okay? And so in a nice recent paper, Jean Kai and Alain de Janvry and Betty Sadoulet examine these questions in a randomized controlled trial in China. So what is the design of this experiment? So this is a village level randomization. Okay. So in the first treatment group, okay, villagers are offered insurance with a 70% discount. Okay, and about 40% of them buy the insurance at this price. In a second treatment group, in another 62 villages, villagers are first offered insurance at the same price, like a 70% discount. But then they are surprised with a further discount, basically 100% discount, and they get the insurance for free. And so, of course, in this second group, everybody then gets the insurance. Okay. This is in year 1. And then they are interested in looking at adoption in subsequent years. And for instance, in year 2, they also randomize prices, this time at the household level, by varying the amount of subsidies in the second year. They collect data for multiple years so that they can see the full dynamics of this insurance purchase and renewals. And I should mention that in the first year, they also randomized whether households received financial education about the insurance, okay, about what how the insurance works, the benefits, the costs, etc. Okay, so this is another layer of variation, of experimental variation, which I will come back to later. Okay, so it's a very nice paper that builds in several steps. Okay, so the first result is that on average, being offered insurance for free in the first year increases demand in the second year, increases adoption in the second year. Okay, right? These coefficients here show that exactly receiving a free insurance in period 1 increases take up in the second year. In addition, giving the insurance for free in the first year does not change elasticity, price elasticity in the second year. Okay? So does not make demand more sensitive to prices in the second year, which will be, for instance, because of this anchoring effect would be the case. Okay. Second result. Experiencing a payout in year 1, okay, increases demand in year 2. This is similar to what we saw earlier, okay, and reduces price elasticity. Okay, so what you can see in column 2, sorry, I should have highlighted here, is that if the price in the second year is higher, demand is lower. This is where my hand is here. Okay, but this price sensitivity is mitigated if you have experienced a payout in the previous year, right? The sign of this coefficient and of this coefficient are opposite, and so experiencing a payout in the first year not only increases demand in the second year, but also makes demand in the second year less sensitive to the price at which the person can buy insurance in the second year. Okay. And also, and this is a bit different from the India style I showed earlier, payouts to other network links, to friends or relatives, do not matter if you had bought the insurance in period 1. In that case, what matters is your own payout. But of course, they matter for those who haven't bought the insurance themselves, because they don't experience their own payout. They only see payout among their social contacts. Okay? But so there is a payout effect. Okay? This is the coefficient that I wanted to discuss. In addition, year 1 subsidies mitigate the payout effects. Okay? So if I've received a subsidy in year 1, my demand in the future depends less on whether I have experienced a payout or not in year 1. Okay? And so the year 1 subsidies mitigate this payout effect that we had seen in the previous result. Okay. And so what's going on? It's important for policy design to examine the interaction between subsidies and payout experience. Okay. So giving the insurance for free, giving larger subsidies in period 1 increases on average adoption in the future periods. Why? Well, a first effect is that, again, giving free insurance increases the share of people who experience the insurance in year 1, and this may increase familiarity with the product, may lead to more experience with the functioning of insurance, etc. And this in turn may have a positive effect on demand in the second year. Okay. However, when the households receive free insurance, they also appear to pay less attention to insurance outcomes. And in other words, receiving insurance for free in the first year makes it less salient if you get a payout or not in the first year. Okay? And this can be good or bad, right? Because paying less attention to payout means that relative to a world where people pay attention to payout, there is less demand if there is a payout in year one, but potentially there is more demand if there is no payout in year one. Okay? And so again, this has implications because, for instance, the optimal subsidy design may depend on how frequent payouts are in a given context. There are some insurance products that only give a payout if you have a terrible outcome. There are other insurance products that, that pay a payout as soon as you have a not so great outcome. And so the optimal strategy of subsidizing may depend on which type of products we are dealing with. Okay? There is one last result which I want to highlight, and this has more to do on the long-term effects of experiencing a payout. Right? The previous results, were all about the impact of year one outcomes on adoption in year two. In the final part of the paper, Kai and co-authors look at longer-term adoption over 3 or 4 years. Okay? And so they show that experiencing a payout in year one has a long-term effect on subsequent take-up, but only for farmers who received financial education about insurance. Remember, in year one, they had also randomized whether farmers received or not this free insurance. Okay? While on the other end, where farmers receive or not this free, this financial education about the insurance product. On the other end, for farmers who did not receive education, the effect of a payout decays over time. Farmers who did not receive financial education about insurance seem to put a lot of weight on the most recent experience. And so, for instance, if in the most recent season they didn't get a payout, they are not going to buy insurance, even if 3 years ago they did get a payout. Okay? And so what's going on? The authors propose this interpretation. For farmers with financial education, a payout reinforces understanding of the insurance. If I get education about how the insurance works, and then I see this in practice, this helps me to understand even better how payouts work. And that thing sticks with me. Okay. On the other hand, for those without financial education, a payout makes adverse events more salient. But this effect is short-lived, and what really matters is how recent the last payout was. Okay, how bad the last year was. And so, what are some policy implications? Again, the optimal subsidy design, if we want to foster not only initial adoption, but also subsequent adoption, well, optimal subsidy design may depend on the frequency of the payouts. And then this work suggests potential complementarity between financial interventions like subsidies and non-financial interventions or non-price interventions like giving financial education. Okay? So it is the case that subsidies may raise long-term adoption, but especially when they are combined with complementary intervention. Okay? So I have one slide left about future research areas with some ideas for what it matters. Let me take a break to see if there is any question at this point. I don't see anything in the Q&A, but feel free to jump in if you want to ask any question before we wrap up. Okay, good. Okay, so I'm close to the end. In this final slide, I just want to propose some areas for future research and some ideas that I've been toying with, and that I would be very happy to see young scholars develop. I think these are important open questions. So let me start with something close to the work that I've been doing. I did mention that the way I think we see our paper with Jack Willis here is to show that sort of proof of concept that if one can design pure risk management products, then demand may be much higher than compared to traditional insurance products that are to be paid upfront. Okay, but of course, then the devil is in the details. How do you achieve this pay at harvest premium? How do you enforce it? Is it feasible in other settings outside of contract farming, for instance? And so, should we think of promoting this type of products in cooperatives or to link it with microfinance? More generally, in the industry and among practitioners, there is a lot of interest in bundling insurance with other products, with other services, inputs or other things, and understanding how this works. Okay? The second point is that, as you may have guessed, as you may have seen from in the slides I discussed yesterday and today, a lot of the work, at least of the academic work on insurance, centers on agricultural insurance and health insurance. These are, of course, very, very important topics. Okay? But other types of insurance are likely to become more important in developing countries. Maybe they already are, and they are going to become even more important in the near future. Motor insurance, theft insurance, cyber insurance, and at least to the best of my knowledge, and at least in the economics domain, there's very little academic work on these products. So I think there is a lot of interesting space to understand the demand and impact of this type of products. And then, one consideration that maybe I've only alluded at throughout the presentation is that a lot of insurance programs are in fact administered by governments. Okay? And this opens a whole set of questions about political economy and insurance. For instance, does provision do large-scale insurance programs, government-run large-scale insurance programs, increase government support? Okay? Or does the expectations that government will step in after a natural disaster limit demand for insurance? Or finally, there is a whole set of questions about how governments themselves negotiate with large reinsurance companies, for instance. Our government typically buy reinsurance, so insurance of the insurer, from large companies. And so I feel that this is the type of political economy dimension that, to the best of my knowledge, is not really explored so far and could really lead to interesting research questions going forward. Okay. So before I wrap up, I see one couple of Q&As. Yeah, so let me read them. Jose has a question about non-monetary costs to insurance. Okay, and could this also limit access to free government insurance programs? And yes, absolutely. I mean, of course, this was true not only in developing countries, right? If you think of the Obamacare, we all know about the hiccups with the servers, etc. But for instance, the paper by Banerjee et al. On the Indonesia health insurance suggests that these non-monetary costs are very important. If you need to register, and then it turns out that the registry is not updated, that members of your family are not there, and this creates additional hassles, right? That's one example in which this type of poor state capacity really limited adoption of government services. Yeah, that's a very good. So Sakina has a question on gender differences in insurance take-up. This is something I should know, and I'm afraid I don't know much. So I don't have a good answer to that. Yeah, so definitely something that to look at. It would be very interesting to study this. So can social norms and religious beliefs affect demand for insurance? Yes, there is a very nice paper, recent paper on the QJE by Oriol, Amapamin, and others that looks at the interaction between membership in religious groups and access to insurance. Okay, potentially as a substitute. There could be other reasons why they could be complement, but yes, I think that more generally, right, interaction between other forms of insurance, let's call them informal insurance, and formal insurance products is a very interesting one. Couple more questions. Let's see if we still have time. Yeah, just a minute. So why do payouts create an adverse event for subsidy when there is no financial education? So let me clarify there. I think this is a question concerning the recent paper. Basically, the point is that if without financial education, you may experience a payout 3 years ago, okay, but this does not have a long-term impact. Okay, if you don't really understand how insurance works, what really matters maybe is the most recent payout or the most recent lack of payout, because that makes the natural disaster very salient, very recent in your mind. And so if people don't really understand how insurance works, then even experiencing a payout in, let's say, year 1 will not have long-term consequences. Okay. And let me take maybe one last question by Ramiro on data protection insurance. Here I just meant, let me be clear, cyber insurance, for instance, as more people work with credit cards or with mobile money, right, there is risk that in using this type of platforms, okay, and there are insurance products that cover losses in this domain. Okay, and we know that more and more people, even in poor countries, are now increasing use of this type of e-commerce, e-transaction. So I think this type of insurance products will become more important. Another domain is identity fraud, right? Identity fraud and identity theft. As more and more governments implement platforms with digital services, I think this is going to be more relevant even in poor countries. Let me wrap up here. I think we are right on time. Thank you very much for joining yesterday and today. I hope these 2 classes have been useful and for some at least inspiring. And of course, the course continues with my colleagues in the next few weeks. Thanks again for joining, and have a good weekend. Goodbye.